Good morning from London. I'm Anna Edwards alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. A trade war erupts between the world's two biggest economies after the US imposes a 10% tariff on Chinese imports. Beijing responds with levies on coal, oil, LNG and more. But President Trump orders a one-month pause on tariffs for Canada and Mexico as both nations pledge tougher measures on migration and drug trafficking. Plus, UBS promises $3 billion in share buybacks after reporting net income well ahead of estimates. We'll bring you our interview with the CEO CEO Ermotti in a few minutes' time.
Tariffs definitely the dominant theme when it comes to what is happening with the trading story right now. But you've got a whole load of banks numbers this morning. You've got a lot of earnings that Europe's got to digest. European futures are absolutely flat right now going into the opening trade. S&P futures still a little soft, but we're kind of oscillating. We're trying to figure out how to digest what is happening between the US and China. Where we are seeing action is in the crude market. It is down again. Keep an eye on the oil majors this morning. Keep an eye on the airline stocks as well at the opening trade. Plus gold hovering around record highs. Is that the right way to play the trade story? The countdown to the opening trade starts right now. Tuesday the 4th, good morning, folks. This time yesterday, the trade war had started. By the end of the day, it had stopped. This morning, it is back on again, and this time, it looks like China wants to place, going toe-to-toe with the United States. The response has been quick. Markets digesting what could be a stickier side, Anna, to this story.
Yeah, absolutely. I mean, toe-to-toe in the sense that there is a tariff. It's not on everything, though, is it, Guy? It's on some really high-profile US exports, and it's also on some commodities. But I think what's interesting is the way that the market seems to be taking this broadly in its stride. Can't believe we're talking about tariffs on China and the Hang Seng goes higher, but there we are. That's the world we're in. And just it illustrates the unpredictability of all of this. The fact that this time yesterday, this time on Friday, we thought Canada and Mexico were going to be the story, and now they're not, but China is.
It's interesting, the Chinese market actually seems like it's responding still to the deep-seek story, which it's still playing catch-up on, which is fascinating. So the AI trade, the barber trade, that's all a big part of that narrative. The trade story may be a little less, but we don't have mainland trade yet, so we've got to think about how we factor that into our thinking too. It has yet to return from the holiday. But just the volatility around the narrative on tariffs is absolutely fascinating. Why is Trump not delivering when he said he was going to deliver? Doesn't he just look like a paper tiger at the moment, that we aren't going to see much of an effect, that the market was right when it was saying basically we think it's the art of the deal, it's negotiation? Yeah,
absolutely. There was a point yesterday where voices at the White House were pushing back and saying, look, this isn't a trade war, this is a drugs war, this is a migration conversation. And we were all scratching our heads thinking, OK, so this is tariffs are then just this tool to be used to enforce your will on weaker partners, weaker parties when you're trying to get something in foreign policy terms or whatever your agenda is. But then we see the China story, and that tells us something a little bit different. There we do have a tariff going ahead.
So where does the EU ultimately sit in all of this? Because we've yet to see them apply to the EU. The language coming out of Brussels is fairly robust at the moment. Does the EU respond like China? Or does it respond like Canada and Mexico in terms of the threats that are likely or have been positioned to come from Donald Trump?
Yes, and how do businesses position themselves with all of this uncertainty? We're going to get to some conversations a little bit later in the programme that maybe flesh this out a bit, but I was having a conversation with the Infineon CFO just earlier this morning, who was talking about, no, we have not factored into our modelling, our thinking, our expectations and estimates, a big global trade war. That's not what's in there. We have, though, started to think about how this is going to impact us in certain areas and included some small increase in tariffs in those numbers.
There is evidence this morning that the banks are benefiting from some of the volatility that we are seeing around the world. You look at the numbers that we've got out of BNP Paribas this morning. We'll come on and talk to Lars Machenil, the CFO, in just a few minutes' time. You talk about UBS and what is happening there as well. The narrative is quite a strong one in terms of what they've been able to deliver on the trading front as well. The volatility to certain businesses in Europe creates a benefit. Yeah,
absolutely. And thinking about what this does to the US economy, I was interested to see Bloomberg Economics giving us an update after the cancellation of the tariffs on Canada and Mexico, giving us an update on what the inclusion of the tariffs on China means for the US economy. And they had said that the average US tariff would go up from 3% to 10% with all of the North American activity planned. But now that's not going to happen, and it'll go up to around 4%. So it is going to see an increase in the average tariff on US imports, but not to the degree that we had perhaps feared. Guys, should we talk about UBS a little bit, about what they're delivering there, a beat and a buyback, a $3 billion buyback seems to be one of the headlines.
Similar for BNP as well. Looks like trading has done very well. CIB Ermotti talking to Francine Lacroix, talking about the idea that the investment bank is gaining market share. This is giving him quite a lot of cover in terms of his ability to push through the consolidation that he's obviously got to deliver with Credit Suisse. So that is a huge kind of boost to him and allows him to push this bank forward to deliver some really solid numbers. In terms of what he's also saying, he's expecting more clarity on the Swiss bank in May, so this job is still ongoing. He is talking about the geopolitical story as well. Sees a willingness of parties to negotiate on tariffs, downplaying the risk maybe that is applied.
Yeah, we've seen that perhaps. Interesting on the US economy, interesting the different push and pull on the outlook there for UBS, but for the others in the banking sector. On the one hand, there is this huge uncertainty around global trade and what impact's that going to have on the US economy. But then on the other hand, there is the potential for tax cuts, and there's all of the excitement that we know some in the US feel about the Trump agenda. So that's certainly worth keeping an eye on. So that's from one business that at least has one eye on the tariff story to another that has a really big focus on tariffs, and that would be Diageo, of course, in the drink space.
Withdrawing its guidance. So it is withdrawing its midterm, I'm assuming that's what M/T means, guidance, a 5% organic net sales growth. They are in the eye of the storm. Maybe the eye of the storm's too calm a description. They are at the centre of the story on tariffs. You saw the story over the weekend of Canadians destocking American drinks from the shelves. The drink sector seems always to be at the kind of the epicenter of the action. You've seen it in tariffs between the US and Europe in previous iterations. We've seen it with Canada now. It's a tough place to be if you're Diageo.
It really is. And if there's impact here from Mexico and Canada, I'm really fascinated as to how, as a management team, you deal with this. And this statement we're getting this morning, was this updated after the tariffs were stopped and there is no sort of imminent tariff coming on, but we still have the possibility those tariffs go on in a month. So do you assume they're coming? And is that what we're seeing reflected in these numbers? They are saying they have anticipated a planned for tariff scenarios. And I suppose that is how you have to think about all of this, because you have one scenario that is as we are with no tariff, another that's in a month we'll have the tariffs we were previously talking about, maybe other scenarios that are tariffs we have not yet talked about.
The adjusted basic EPS, 97.7 versus 108 anticipated. Is there an indication as well that also we are seeing a slowdown in the drink sector, that the consumer is maybe spending less on high-end drinks? It'll be interesting to see what the commentary looks like around that. We don't have any forward guidance now because the tariff story in some ways has upended everything Diageo will be thinking about in terms of what it does next. It can prepare, but the volatility around, and this is the problem for business. Just how do you plan for such a scenario?
Absolutely, and that's exactly what I was talking to the Infineon CFO about, and he was saying, giving those lines about, we haven't factored in a major escalation, but there is some factoring in of tariff impact. Also interesting, businesses such as Infineon fall back on their regional production model as something of a defence in a tariff environment. So if you produce in Asia for Asia, if you produce in Europe for Europe, and in the US for the US, real life is much more complicated than that. And supply chains are a lot more complicated. But at least that's a story that you have to tell to politicians about the amount that you're committed. Right. We should move on, guys, shouldn't we?
Let's go back to UBS. I think it's probably worth doing that.
Absolutely, let's do that. Bloomberg's Francine Lacroix has been speaking to the UBS CEO Sergio Ermotti and started by asking how he feels about the 2024 results.
I'm very happy. 2024 was a successful year for us, and we delivered on all our key priorities, not only in terms of the integration, where we saw major mergers of operating legal entities being successfully executed. We started migrating de facto 90% of the clients booked outside Switzerland and successfully, and we also de-risked our balance sheet, and now we are also making very good progress in our asset gathering businesses in wealth management and asset management. We are gaining market shares in the investment bank in all areas where we want to compete, And we continue to be a reliable partner for the Swiss economies, for the Swiss economy to households and businesses by granting 70 billion of new loans, which makes our outstanding balances at 350 billion. And we are investing for the future. So it's very important for us to think about next. And so we are investing in AI, in new capabilities, new products to stay competitive.
Sergio, when you look at the integration, I mean, it's full speed ahead. You're about 6 months ahead. Is there one month that seems more critical than the others?
No, look, the most critical part of the integration has been always going to be the migration, the data migration. We are migrating in total 110 petabytes of data. 15 have been migrated outside Switzerland. The big chunk of migration is going to start in a few months in Switzerland, where we migrate the balance, around 95 petabytes in 3 tranches, basically in the spring, late year, and the beginning of 2026. And this is definitely a journey that requires a lot of planning and a lot of good work, and the team is on top of it, but we cannot be complacent. So it's a very big task.
If you look at the regions, how are you satisfied with the progress in Asia?
Very good. I mean, in Asia, if you think about the fact that we have been growing very fast, but most importantly, we have been doing that while going through the migration. And so all our colleagues, front to back, have been somehow distracted by that, but at the same time, they were able to stay close to clients, grow assets, grow our business, and be a reliable partner. So in that sense, I'm also pleased to the progress we make in the US, both in the investment bank and also in wealth management, where we are now executing on our plans to restore a good level of profitability. And in the investment bank, we are gaining market share.
There's a lot of optimism of banking in the US. How will you take advantage of that?
Look, I think that we are in the U.S. is a very important market across the board for us. Is the largest wealth management market in the world. We are an important player there. We want to enhance our capabilities. We want to enhance our profitability. And in terms of the investment bank, we see a good momentum in the pipeline building up. Having said that, if you look at year-to-date volumes and activities in capital markets is down 26% year on year. So while it's a very promising pipeline, the truth of the matter is that the year has started in a rather slow way compared to last year.
The UBS Group CEO Sergio Ermotti speaking to our colleague Francine Lacroix, of course, and much more, of course, in that conversation available on the Bloomberg terminal and on the website, Guy.
We'll get back to Francine very, very shortly. We've got some other great guests coming up on the show as well. Let's talk about who they are. Anthony Gardner, President Obama's ambassador to the EU, will be giving us his views on what is happening with the tariff story. Anne Doe, Julius Baer, portfolio manager, talking about how you should position around this. How do you deal with this volatility? How should you think about it? Aditya Babe, Bank of America's global research senior US economist. So much to talk about there. How is he factoring in the latest decisions by the Trump administration into his models? Malte Heiner, Hamburg Chamber of Commerce CEO, is going to be joining Ollie Crook a little bit later on. We'll be talking trade. We'll be talking the German elections in that conversation.
OK, lest we forget about the data, we will have some data later on today. 3 p.m. UK time, US factory orders. We'll get durable goods from the States as well. Bit of geopolitics in the mix. Netanyahu visits Trump in D.C., so that could be a relationship to watch, of course. Earnings in focus then, Guy. We have Alphabet coming up, Spotify, AMD, PepsiCo also, but Alphabet really of interest. We've already seen Google being hit by a tariff from, by an investigation by the Chinese, seemingly in retaliation for what we've heard on tariffs. I mean, symbolism, plenty of symbolism in this, because Google doesn't have much of a business in China. But still, that's going to be something that we'll be watching. And cloud, whether they maintain momentum, and AI.
What's been really interesting in the sell-off that we've seen around tariffs is that you would have thought that tech would be relatively immune from what we see. Maybe the hardware companies get a little bit of an impact, but nevertheless, you would have thought services would be largely immune from this. But tech has sold off really quite aggressively. And does that tell us a lot about kind of market positioning and about how people feel about the extension of the move that we've seen around these stocks over the last few weeks?
Or is it the point that you made earlier, which is that there's still the deep-seek theme, and we're still trying to get our heads around that and wrestle with what that means in terms of the amount of capital expenditure businesses at all parts of the supply chain need to dedicate themselves to deliver this? And Palantir was interesting, thinking about AI and what it delivers. I mean, this is incredible language, isn't it? Untamed organic growth. They supply to the government, of course, but a lot of this is around AI and just the ability to use that word untamed in reference to organic growth.
But they are users, not producers of the products, and that's really interesting as well. And the DeepSeek story is about reducing costs and making this more available at a lower cost to more businesses and people. And in some ways, Palantir is going to be at the kind of the leading edge of that. And certainly the numbers suggest that. NVIDIA has not had a great start to this year, to your point about actually kind of this could be something of a longer term effect. What else do we need to know this morning? Let's run through the details. With less than 20 days until the German election, the Conservative frontrunner Friedrich Merz is refocusing his campaign proposals on reviving the economy after a clash over tougher immigration rules. Last week, Merz provoked outrage by accepting votes from the far-right's AfD, Alternative for Deutschland party, for a draft law on tightening immigration rules, which in the end didn't pass. Merz is now ruling out cooperation with the AfD and stressing his party's commitment to supporting Europe's largest economy. The UK Treasury has told government departments to prepare for their budgets to be frozen in cash terms ahead of a major spending review planned in June. The ruling Labour Party has previously pledged to avoid a return to austerity, but the public finances are under pressure from high borrowing costs and the stagnant economic growth story. Unprotected areas like justice, culture, trade and local governments are at risk of being squeezed. And the French government is facing a no-confidence vote after the Prime Minister bypassed the lower house of Parliament to force the adoption of his budget for this year. The far left has said it will file a no-confidence motion and a vote is expected Wednesday, tomorrow. But Francois Bayrou's government could survive if the socialist MPs follow guidance not to support it.
Coming up on the programme, Trump's tariff threats risk driving a wedge between the EU and the UK, just as Prime Minister Keir Starmer looks to reset relations across the Channel. We'll be live in Brussels with those details. Plus, we'll bring you some of our interview with the Infineon CFO, Sven Schneider. That's coming up later in the programme. There was an upgrade to guidance, a lot of that driven by FX and a weak euro, so that could have an impact on trading at the start of our trading day. Up next, we'll bring you a conversation with Lars Machenil, the CFO of BNP Paribas, after the French bank reported a better-than-expected net income. If you want to get involved in any of these conversations, IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
Seventeen minutes past the hour. Welcome back. You're watching the opening trade. Let's talk more about the bank earnings that we've seen drop onto the Bloomberg terminal this morning. We've talked about UBS. We've heard from CIB Ermotti. Let's now hear from BNP Paribas. The bank has this morning delivered some strong numbers. Fixed income trading beats significantly. Equity trading beats significantly. We've got a new share buyback. We've got a higher than expected dividend. Lars Machenil, the CFO of BNP Paribas, joins us now. Lars, the numbers look good. Certainly the market, I think, will be happy to hear about the returns that we are going to be getting. Is this kind of performance sustainable? Trading is really strong at the moment. It's driving your numbers. But with volatility must come volatility.
Yeah, well, if you look at it, you know, our CIB at this stage is firing on all cylinders. You've seen it basically up 20%. And if you look at global markets, both debt and equities are doing very solidly and up 30%. So there is this volatility and we aim to serve it. Now, let's not forget, we are diversified. Yeah. So maybe at some day there is more demand in one product or there can be others in another one. So we feel comfortable and the Q4 shows that we are right on track. We've shown that the bottom line has grown by 15%. We've stepped up our dividend. We even introduced an interim dividend to be paid in September of this year. So from that point of view, we feel that everything is on track and our platforms are delivering.
You're firing on all cylinders. The CIB is firing on all cylinders. How do you improve on firing on all cylinders?
Yeah. So by firing on all cylinders and basically having all products available, we increase our market share. And by increasing our market share by all of the products we have, that basically means we step up market share while maintaining margins high. So we are in very high value-added services. We take market share, and that is what we continue to do.
Lars, good morning. I wonder how you feel about the year ahead, the lack of visibility we might have, given tensions around trade, global trade tensions, very clear to see this morning, and yet some optimism about what the US economy can deliver. How does that leave you positioned?
Yeah, listen, if you overall look at it, we at BNP Paribas, we support and are able to grow faster than the intrinsic economy. So if you look at the US and even if you look at Europe, there are different roads ahead. So there is some volatility that we've seen in the US, but there is also plans of growth and stimulating growth in Europe. If we look at what the new European Commission is thinking about their compass, yeah, the project that basically goes around three axes: innovation, competition, and also security. And if you look at competition, if they really can bring down barriers intra-Eurozone, that could have an impact. It's an illustration, right? But imagine that they bring down some of the barriers within the Eurozone and that trade within the Eurozone would go up 2.5%. 2.5%. That would be the equivalent of a lowering of the trade with the US by 20%. Just to show you the kind of levers that Europe has.
OK, so Europe can employ some self-help measures then, perhaps, in terms of its competitiveness. Thinking about that transatlantic relationship, we might see reduced regulation on the banking sector in the United States, Lars. What would you like to see in Europe?
I take it, and that's the discussions we're having, that there has to be a level playing field in some of the global activities. And so that is what we assume that Europe will go for. Yeah, there will always be difference between the two, but on the key elements that matter, there should be a level playing field. Let me give you the example of everything that is market related, where there is a regulation called FRTB that Europe has postponed to observe what the US and the UK is doing. So from that point of view, I observe that Europe is wanting to have the right balance in the products and the services where it matters.
Lars, let's talk a little bit about M&A and the structure of the business. Is the commercial and the retail operation a drag on BNP Paribas at the moment? You can see evidence of that within these numbers. So is it a drag, and what are you going to do about that? Is kind of a structural change a possibility? You have been, in some ways, at the forefront of it. Sorry, let me answer. Let you answer that question.
No, well, there's two things to that. If you look at the three divisions we're having, there's basically the CIB and the IPS that are quote-unquote firing on all cylinders. And the CPBS activities, they are at the pivotal point. So indeed, at the beginning of the year, there have been some overhang by what we call the headwinds that have been installed by some nation states and the likes. But these headwinds are basically behind us, and that's the pivotal point you see in the fourth quarter. The fourth quarter, you see CPBS picking up strongly. And that basically means that the headwinds that are falling off will probably become now tailwinds, because the yield curve is probably going to steepen and the likes. So from that point of view, we are at that pivotal point. Having said that, that domain, the retail side, is changing. And so we can do more. On the enterprise side, on the wealth side, we can do better to deepen the wallet that we have with the client. And on the pure retail, we have to continue the digitalization and adapt it. So that's basically what we're doing.
OK, let's look at what else you could do with the business as well. We're obviously all watching what Andrea Orcel is doing and his moves that we're seeing around Europe. You guys have obviously done quite a lot of consolidation. I think you're going to conclude the AXA IM acquisition fairly shortly. Do you see yourself as a consolidator still? Is there more to be done in Europe to make the business and its structure different and better?
Yeah. Well, listen, there are, if you look at it, there are too many banks in Europe. Yeah, there are more than 6,000 banks in Europe. That's way too many. So we would have to get to a consolidation. But regulation today totally supports in-country consolidation. And so all the things that you see floating around, that's basically what it is. It allows to capture synergies and to optimize within a country. Now, the countries where we are present, this already happened. We already consolidated in Belgium and in France. So for us, that part in banking is not really on our agenda. For us, it's on the agenda for adjacent activities, like what we've mentioned on AXA IM, so in insurance, or with the wealth management we onboarded in Germany from HSBC. So that's the kind of domains in which we see that consolidation is really going to work and where we can play an important role.
Lars, can I ask you about French politics and the extent to which you expect volatility there in 2025? We're waiting to find out what happens with this budget this week. Any message to the politicians who might be either tempted to pass it or tempted to bring down this government?
Yeah, I think it's like with the regulation we talked about. You have to find that tender balance between addressing the debt to GDP issue and not suffocating the economy. So that's the right balance they have to find. And so if they are on track to make something land that strikes that balance, that is what is needed.
OK, Lars, thank you very much. Thanks for your time. The BNP Paribas CFO, Lars Machenil. And maybe, Guy, we just linger on that point a moment, because we've gone from a point of high tension around France to a place where the market seems to be at least pausing in its level of anxiety and perhaps even reducing that anxiety a little bit. We've seen the spreads over Germany, of course, coming down. And all of this because the socialists say they will not support any no-confidence vote. And so that looks as if maybe Bayrou gets to survive.
Bayrou's talking about climbing a mountain, and it looks as if maybe he's at least able to establish a kind of base camp at this point. How much more mountaineering he ultimately has to do to continue this government remains to be seen. But this is a big milestone for him. If he can get past this milestone and deliver a budget, maybe no budget, maybe a budget is better than kind of a sort of a bad budget is better than no budget, that would be a big milestone for him. And does it just allow a little bit of stability to go forward in France and deal with the other issues like Trump and all the other kind of factors?
There's plenty that is sort of existential, or sort of external rather than the internal.
And potentially existential, we'll see.
I mean, potentially existential. We might get more headlines around this, though, because we still don't know what the National Rally's view on it is. I mean, with the socialist support, Bayrou is probably safe, but we don't know what Marine Le Pen intends on this front. No. It is going to be... The French government is going to be volatile until we get new elections potentially later on this year. We'll see whether that is actually a necessity, but that's where we appear to be heading. We'll see if that comes about by the summer. So coming up on the programme, the trade war between the US and China ramps up. We'll dig into the story with the former American ambassador to the EU, Anthony Gardner. That's next. This is Bloomberg. Welcome back, everybody. This is the opening trade. 30 minutes until we get that opening trade. So the futures picture looks like this for Europe. Given what has been thrown at these markets, this picture does not look as risk-off as it could have looked. So we've got Euro Stoxx 50 futures actually up a touch this morning. S&P futures pretty flat. Nasdaq futures pretty flat. So on the one hand, we've had the end of the tariff, for now, tariff conversation with Mexico and with Canada. But we do have tariffs on China, and we have Chinese retaliation in the shape of commodities and well-known US brands. So there's plenty to talk about on tariffs still, and further news flow, no doubt. But for the moment, that's what we see on European equity markets. And this is the picture on bonds. Yesterday, of course, we saw yields dropping. There was a lot of haven buying of bonds. And then we overlay on that the French political story. Despite all of that, we've seen the spread coming down. Despite the French politics, we saw the spread coming down of late, as we discussed in the last part of the programme. So this is the picture reversing a little bit of the story of yesterday in terms of the bond market here in Europe.
It's quite the roller coaster we are on right now. The Chinese story looks like it might be a little bit stickier when it comes to the tariff narrative. Beijing already hitting back at Donald Trump's 10% tariffs on Chinese goods with a raft of retaliatory measures on US products. The moves between Beijing and Washington threaten, of course, to reignite a trade war between the world's two largest economies. The US president says he's ready to engage, though, with his Chinese counterpart.
We'll be speaking to China probably over the next 24 hours. China's involved with the Panama Canal. They won't be for long, and that's the way it has to be. If we can't make a deal with China, then the tariffs will be very, very substantial.
What kind of a deal is he looking for? Let's try and figure this all out. Derek Warbank joins us now to discuss. Derek, kind of walk us through where we are. We started yesterday talking about Mexico and Canada. We've moved on to China. Is there a sense that the Chinese story is actually probably going to prove more intractable and difficult to negotiate a deal on? and therefore proves more sticky?
It's a great question. Let me start at the very beginning. When we were going through the campaign, Donald Trump campaigned on tariffs. He said tariffs were going to be a major part of his economic policy. He has talked repeatedly and at length about how tariffs were going to fund any number of things in his domestic agenda, right? So start that out there. Trump had planned on tariffs as a very big thing. He has threatened a fair number of them, right? You mentioned Canada, you mentioned Mexico, China, obviously, the European Union, Colombia, there are others. But right now, this is the first really big one that's actually gone through. He was meant to put on 25% tariffs against Canada and Mexico. Both of those got worked out with a 1-month pause in exchange for not very much. You would call it modest at best. Offsets from both Canada and Mexico, and both of those were sort of on the border side, not on the economic trade side. This one on China has gone through. It was allowed to take effect. Trump did not have it take effect with some fire and fury. He just let it happen. China was instantly ready. They responded with a number of things that are put under tariff. But if you sort of look through this list, it's not a lot of stuff that seems extremely escalatory right now, which is part of what may explain the market reaction that we've seen so far.
Yes, I mean, where do things stand then in terms of talks between the US and China? We heard President Trump there talking about how he wanted to have a conversation with the Chinese leader. Clearly, that didn't produce enough, quickly enough, to not impose tariffs. Tariffs now do seem to be imposed, but the next question will always be for how long? And I wonder where we are in terms of those talks.
Yeah, I think that's a really live question right now. We don't have any indication that those talks have firmly happened as yet. So we're waiting to see when they do happen. How long is that conversation? What comes out of it? Trump does like to give pretty detailed readouts. China will have its own readout as and when those conversations happen. But look, Trump has said that he wants to have tariffs on China. He's blamed China for a whole number of things, fentanyl imports being one of them. So there's a lot at play here, right? Not least of which, as I mentioned in the first question, that Trump has said that he wants tariffs to fund a fairly large part of his domestic agenda, and he has not put on anywhere near the amount of tariffs required to do that. Nor, I should mention, has he put on universal tariffs, which he said he's wanted to do at a level that's much bigger than 2.5%. So, or sectoral tariffs even. As I say, the list can go on. There are a lot of threats on the table. So that's kind of where we sit there. Interestingly enough, though, I think it bears mention, one country that he has not said is the subject of imminent tariffs is the United Kingdom. Remember, Trump was asked by reporters over the weekend what he thought of the United Kingdom, and he said that there were problems there, but he thought they might be able to be worked out. And he had very, very nice things to say about Sir Keir Starmer, which was a very interesting development, especially considering how Labour and the Trump wing of the Republican Party have not been the best of friends.
Yeah, Derek, thank you very much. Bloomberg's Eric Wallbank with the latest on the global tariff themes. Let's get to some of those with Anthony Gardner, who served as the US ambassador to the EU from 2014 to 2017 under President Obama. He's currently a senior advisor at Brunswick Group. Anthony, very nice to have you with us. And I will return to the sort of European dimension on this in a moment, because clearly that's where a lot of your experience lies. But I just wonder, stepping back more broadly, are you able to articulate the aims of the Trump administration and its tariffs policy right now? Because on the one hand, they talk about wanting to reduce income tax and providing a different revenue stream. But on the other hand, they're using tariffs as a way of driving change from partners or adversaries or whoever. Do you have a sense of what the tariff policies are for?
Well, look, I'm not in favor of them. I think they're misguided and they're a risk of ripping up the world trading system. But it's clear what he thinks they are. He thinks that they serve as a unique tool for leverage to make countries, as you say, do what he wants them to do, not just in the commercial area, but in a non-commercial area as well. He thinks that there are no downsides. Importantly, also his teams appear to think that there are no downsides, including inflation, which you mentioned, or a weaker dollar. So he thinks, look, the U.S. is such a large market. We depend less on global trade, which is true, than most other countries, including the European Union. Therefore, tariffs are the answer to everything. But we know what tariffs do, to be clear. I mean, tariffs are a tax on consumers, and not only that, it is a regressive tax, the one that hurts those who are least well off. And the impact is not just on consumers, it's on those who use imports to actually manufacture for export. So it makes manufacturers less competitive, and tariffs, of course, lead to more inflation, as you say. So I think it's a mistake, and it will lead to retaliation, as we're seeing right now, and the EU is preparing its own lists.
Yes, and what do you think that should look like? I mean, if you were sitting in Brussels right now, Anthony, what would the list look like? They've been here before. They had a list for the first Trump administration, so maybe it's a carbon copy of that.
Well, look, their first course of action is to try to negotiate a deal with Donald Trump, just like in the first term, as you said, which means buy more American goods, which happened in the first term, buy more soybeans, buy more liquefied natural gas. And by the way, in the first term, it was a bit of theater because the trends were already going in that direction. And the European Commission, as your listeners will know, doesn't buy anything. But Donald Trump pocketed it as a win, and he was happy. This time they may add some, defense, weapons procurement, but there again, it's not going to be easy because the European Union right now wants to buy more domestically and build up its own capacities. Now, if that fails, it will try to convince Trump, look, there's a positive agenda for us here. We are spending more on defense. There are things we can do together on China, for example, on export controls, on supply chain resilience, on cooperating and writing rules on global trade, all that stuff. I don't think Donald Trump will be particularly impressed with that. So the EU is preparing for retaliation. By the way, its toolkit, as they call it, is much more effective now than it was in the first. They can respond far more quickly and far more, let's say, impactfully than in the first term. They could hit services trade, where, by the way, the U.S. has a surplus and not a deficit with the EU. And if it really, really wanted to get tough, it could close off the very large EU public procurement market and say, buy European.
Ambassador, that sounds very dramatic. Is there a danger that the action of the Trump administration drives the European Union back towards China?
Yes, there is. That's not where the winds have been blowing recently, because the Chinese, through their wolf war diplomacy, have actually pushed the EU closer to us. Look, I've seen a dramatic shift. When I was in Brussels, a lot of EU member states were flirting with China, including Italy. Things have changed dramatically. The UK was rolling out its red carpet. And over the years, the EU has adopted a view in almost all instances, Huawei is just one of them, much closer to the United States. Now, what Trump is about to do is to say, the United States is bullying its way around the world. It's going to bully the EU to get what it wants. It's threatening a member state and a NATO ally, including regarding Greenland, and convincing some member states, you know what? China is not looking so bad right now. Maybe we should cooperate more with them. That's a dramatic shift.
Do you think the apparent friendship he is expressing towards the United Kingdom will drive a wedge between the UK and the European Union? How do you think Keir Starmer should navigate that? Is that going to be more problematic than helpful, do you think, for the British Prime Minister?
It's a very tough line to walk, indeed. Obviously, the UK wants to avoid tariffs. It's probably in a better place than any other member state to convince Trump that it is not an enemy. And I use the word enemy because Trump has described the European Union as an enemy, not only commercially, but more broadly. And the UK is in better position because the statistics show, are rather confused here as to whether it runs a deficit or a surplus. The US and the UK have a different way of measuring these things. But certainly it doesn't run a massive surplus like Germany or Italy. So it's in a better position. Having said that, the UK, as you say, does not want to completely alienate its European allies here because it's in the middle of a negotiation to try to reduce some of the barriers that are created by Brexit on some very technical things like veterinary trade, but also on movement and so forth, and also on defense and security. So you're right. Very, very tough line to walk.
And thinking about the impact of US policy on China, on Europe, because these are all interrelated, of course, Do you think that we will see more Chinese product coming to Europe? And will the impact of that just be lower prices for some European consumers, something that some might welcome, or will there be a political dimension to that?
This, for me, is the critical question. So the divergence in the tariffs that we have seen on EVs, and we're going to see in other areas, between what the U.S. imposes on China and what Europe imposes on China, that divergence almost certainly will drive displacement of significant Chinese trade toward Europe as one of the last and richest markets available for Chinese exports. And by the way, sure you and the people watching have seen a lot of analysts showing that even with tariffs, Chinese manufacturers make a higher profit in the European market than domestically. That diversion will drive a lot of increased exports to Europe at a very, very time of fragmentation in Europe and industrial weakness. That's really big news. You're right, consumers will benefit, but Europe needs to preserve its industrial manufacturing base, and so we'll have to respond. I suspect what it will do in part is to say to the Chinese, you can do this and you can access our relatively open market, but we want you actually to manufacture in Europe, and we're going to impose the same requirement that you, the Chinese, have been imposing on the rest of the world, transfer of technology to our manufacturers on European soil.
OK, we'll watch that and see how that develops. In terms of the European-US relationship, do you think, well, how much defence spending do you think Europe has to commit to get the Trump administration off its back, if that's the right phrase to use? How much would be enough?
Well, look, 5% is crazy, right? That's not going to happen. Poland is probably spends, I think, most in terms of GDP for defense. But for some countries who are way below even the 2% threshold, getting to 5% is crazy. Even 4%, even 3% would be tough. I'm thinking about Spain. I'm thinking about Italy. I'm thinking about Belgium, which is at 1.1%. So we have to be realistic. The trends are in the right direction. I mentioned Poland, also the Baltic states, France, a number of others are actually doing significant amount, improving their spending, in Germany as well. But I want to make one important point here. And that is, it's not just about defense. The landscape for U.S. and European relations now are the most troubled I've seen in 35 years. Why? Not just because of tariffs, but because of a number of other things that are happening. You know that the U.S. wants to go out of the multinational tax agreement that was struck at the OECD. That will lead member states to impose national digital taxation laws, which Trump will retaliate against. So that's also bad news. The second, there looks like the data privacy agreement that we had in place, I was involved in, may fall because Trump has fired 3 Democrats from the Privacy and Civil Liberties Oversight Board, the critical organ that was supposed to monitor this agreement. And third, Donald Trump's tech bros, as we call them, have convinced him that all of the investigations against U.S. companies at the EU are discriminatory and anti-American, and therefore need to stop. Well, that isn't going to happen for a lot of reasons. The digital market rules and antitrust rules are core to the European Union. If that doesn't happen, Trump will perhaps want to retaliate. So for all of those reasons, I have to tell you, there is turbulence ahead, and I regret to say that.
It's going to be a bumpy relationship, isn't it? Ambassador, thank you very much indeed. Anthony Gardner, former US ambassador to the European Union. Coming up, we're going to get back to the banks. UBS announces a $3 billion buyback after beating estimates. We're going to check in on the Swiss lender and talk about some of the other financials that are in focus this morning. BNP springs to mind. That's next. This is Bloomberg.
Welcome back. 7:49 here in London. So 11 minutes until the start of another trading day this Tuesday morning. And the futures picture shows us Euro Stoxx 50 futures up by 0.3%. A bit of a reversal of yesterday's pattern in terms of the geographies involved. Let's find out where markets might head from here. Rachel Evans, Bloomberg's managing editor for FX and Rates, coverage for the US and EMEA, joins us now. Rachel, let's think about the impact then on market sentiment of what we've heard about China. Because on the one hand, tariffs, Canada, Mexico, gone away for a month. at least, maybe longer. But tariffs on China will be imposed for now. So what, in terms of risk sentiment, do we take away from that?
Yeah, so I mean, this morning we're very much seeing kind of a reaction across the FX space in particular, where we're seeing emerging market currencies rebounding by and large, and we're seeing some of the group of 10 currencies, the major currencies, continuing to fall versus the dollar. So it's this interesting kind of sort of shift in risk sentiment whereby people are a little bit more optimistic than perhaps they were at this time yesterday, but that risk hasn't kind of gone away completely. We did see, CNH, which is the offshore version of the yuan, sort of going a little bit lower during sort of Asian trading, although I would note that it's now come back and is relatively flat on the day, which I think is particularly interesting. And let's remember, we don't actually have onshore Chinese markets open as yet, so we can't really see the impact of these tariffs on the Chinese markets themselves. So that's something we're going to have to wait till after Lunar New Year. But at the moment, it feels like we're seeing some stability. There's certainly some relief around the fact that Canadian and Mexican tariffs are not coming in yet.
Is the lesson from the last 24 hours that Trump's bark is worse than his bite?
Some might say that, but I think the worry is that the barking could eventually lead to a bite. And we just don't know when that might be or if that is actually going to come or not. So I think I've seen some commentary out there that there's sort of a risk that the market becomes complacent and that, this whole idea of tariffs as kind of a negotiating tactic becomes embedded in the market in such a way that when we do see kind of, some of the bluster and the threats, that's viewed as all it is. And then you could ultimately see those tariffs come in and the market has to really react very kind of like quickly and violently as a result of not having prepared. So I think people in the markets are really having to kind of get a sense of how do you actually hedge that? How do you hedge something that might not happen or might get called off at the last minute? And that volatility is really, really difficult for people to digest.
And what clues are we getting from Treasury markets at the moment, Rachel? Because on the one hand, you could have seen at the weekend, are we positioning for higher inflation environment because of tariffs, or are we positioning for a flight into the safety, the haven status of bonds? And we saw a bit of both of those at different ends of the Treasury curve, certainly in the early hours yesterday.
Yeah, and I thought that was really, really interesting and perhaps kind of under-discussed because there was so much going on in other markets. Because, the Treasury market's really been the focal point of kind of this idea of the Trump trade. Are we going to see sort of yields really pushing up as we see more supply, more inflation come in? And yesterday we saw kind of like an aspect of that, but we saw yields at the front end moving higher, so those short-end yields moving to reflect short-term inflation. But long-term yields, as you referenced, were actually coming lower, suggesting concerns about growth and the idea that interest rates would have to come lower in the long term. That is a stagflationary environment, and that's something that is very, very worrying if it were to continue.
Rachel, great stuff. Thank you very much indeed. Rachel Evans. Let's go from the macro to the micro. Talk about some of the single stocks. Joe Easton.
Morning, guys. So UBS announcing a $3 billion buyback today and also beating expectations on most of its earnings points as well. Now, this stock has been a bit of an underperformer versus the broader banking index in Europe over the past year, and there's quite a few sell ratings on the stock as well at the moment, so potentially expectations were low heading into this, and that could help the stock this morning. We can see 5 sells on that stock. Then another company with really low expectations is Diageo. Now, the company today is pulling their main guidance for their sales numbers. We can see this stock losing around a third of its value over the past 2 years, partly due to too much inventory over in the US, so potentially this could be a negative one. Bear in mind, yesterday we did see all of the drink stocks declining on worries around Trump's tariffs, including Diageo and also the peers as well. Pernod is another one. Then in terms of Infineon, bucking the trend of semiconductor companies that have reported weak earnings. That was the take from Citigroup that I read a few moments ago. We can see that stock has had a bit of a volatile run over the past few years now. It does have a lot of buy ratings, not a single sell, 28 buys, no sells on that stock. Potentially they're going to be happy today. Then in terms of rating changes, a couple in the UK to keep an eye on. Reckitt and Pennon both have moves on their ratings, but the one standing out is Novartis, upgraded at Deutsche Bank, could be positive in Switzerland today.
Joe, thank you very much. So, Joe Easton with a rundown of some of the stocks that could be on the move. I mean, broadly speaking, then, we are expecting something slightly positive at the start of trade, a bit of reversal in terms of the FTSE underperforms, which was the opposite of yesterday, and US futures really flat.
So, looks like oil's going to be lower. So that's going to be a factor that we need to kind of think about what's going on here. It's going to be interesting to see kind of what happens with that trade. The Chinese response in some ways feels measured. Is there an escalation risk in here? Is that how we should be thinking about this or not? Because if it's not, then maybe you get a more positive story.
Yeah, is there escalation risk or is there de-escalation risk with calls still planned apparently between the leaders? We will continue to follow, of course. Coming up on the opening trade, we'll bring you the start of the European trading day. Plenty of earnings as well to factor in. This is Bloomberg.
Tuesday the 4th, good morning. Couple of minutes to go until the opening trade here in Europe. Let's talk about the Monday session. It may prove a useful guide as to what we're potentially about to see in the Tuesday session. Europe gapped lower at the get-go of trade yesterday, but we did capture the rally that we saw at the end of the day, driven by the fact that it looked like the tariff story was not going to go into full effect when it came to Mexico and Canada. So that's the rally we captured yesterday. The US session kind of picked up a little bit from there, but was basically neutral as we came into the end of the day in the United States. So where does that take us in terms of the futures picture this morning? Let me show you. These are the numbers we're looking at the moment. Not a great deal of a sense of direction being generated by these futures. They've rallied a little bit as the morning has progressed. Eurostoxx futures are now positive. The FTSE's not. Keep an eye on what's happening with the oil trade this morning, the commodities trade. CAC's absolutely flat going into the session this morning. What impact do we see from the China tariff story? Is that something that is going to be continuing? We are apparently going to see a call between Trump and Xi. What impact could that have? Are we setting ourselves up for another roller coaster, Anna?
Yeah, absolutely. Could we see a roller coaster? Certainly a lot of foggy visibility, a lack of visibility when it comes to the trade narrative. We don't have the trade battles that we thought we'd have, at least not for another month, but we do have other trade battles fully enforced now, but for how long? So lots of uncertainty. Let's talk about the earnings picture and the stocks that are in focus as a result. UBS giving numbers, a $3 billion buyback, surely the headline there. Infineon in focus. This one could go higher, but actually there's a lot of positive FX in there. Do we just assume that that continues? Diageo withdrawing their medium-term guidance as a result of the looming tariff battle in North America. Will that come to pass, Guy?
Absolutely. All of that to be folded into the market this morning. You've got the macro and the micro to think about in terms of the opening trade. So let's show you some numbers, give you an idea of what is going on this Tuesday morning. FTSE 100, the commodities trade may have an impact on what we see out of London this morning. It may be something of an underperformer, despite not actually, on the face of it, the UK facing a tariff threat in the way that maybe the EU is. So the FTSE 100 flat to a little bit negative, down by circa 0.2%. The Stock 600 comes through up by 0.1%. We're not getting a clear sense of direction here at the moment. The IBEX is absolutely flat. You've got to think about the fact that that Mexico and Canada are no longer on the list, but China is. So kind of how do we balance this all out? Plus then fold in some of the corporate earnings. The CAC is now up by 0.2%. Be interesting to see how BNP Paribas factors into the thinking of that market. But broadly, we are just a little higher this morning, Anna.
Yes, just a little higher, up 0.1% on the Stock 600. The FTSE provides the downforce, but elsewhere we are seeing a bit of tentative positivity, still waiting for the Xetra DAX to open. In terms of the sector picture, we're getting some uplift from some earnings stories, but also some of the broader geopolitics perhaps. So basic resources, the best performing sector up by 1%, and that's pretty broad base. So despite the fact we see some commodity prices coming down, we've actually got basic resources moving higher. Banks is another sector in focus, and that is up by 0.9%. We've seen some corporate reporting in that space. BNP Paribas is up by 1.9% on the back of the numbers there. We also see a bit of a rebound in some of the banks that were sold off on trade tensions around Mexico yesterday. So some of the Spanish banks not doing too badly. I mentioned lower commodity prices. Actually, I was talking about oil there, and that does make sense of what we're seeing on the Stock 600, with energy names being the worst performing sector. That's down by 0.5%, as BP drops by 1.4%, Shell down by 0.7%.
Yeah.
So there's a lot happening this morning.
UBS is up by 3%. On the back of its numbers this morning. The banks are delivering. You have UBS up by 3.3%. You have BNP Paribas in Paris up by 2.7%. Both banks are beat with strong trading numbers coming through. Both banks are delivering in terms of the returns they're delivering to shareholders. In some ways, the volatility we see adds some upside to these institutions. They are doing relatively well. And actually, it was interesting to hear Lars Machenel talking about actually a pivot point or also around the retail bank story as well. So maybe a less negative story to tell there. So the banks are doing well. Coloplast is also out in the chemical sector. It is doing well as well. One of the three big gainers in terms of points added to the 600 this morning. BNP Paribas, UBS and Coloplast.
Yes, and we heard Lars Machenil saying they're aiming to service that volatility. There's volatility out there and they want to be making some money on the back of that. We still don't have an opening price, I think, for Infineon, and there is an expectation that that will be a strong performer today. So we'll keep an eye on the technology sector and take a deep dive into what exactly has been driving the Infineon story. And in fact, Infineon is open. It's up by 10% in this morning's trade. We'll get more, though, on what it is that has been driving the gains in Infineon, because there's a positive FX story. To what extent that continues, we'll see. Let's broaden the conversation for the moment, though. Joining us now is Anne Doe, Portfolio Manager at Julius Baer, and a great voice to add some sanity to all of the volatility that we're seeing in markets and
no
some
pressure.
direction. Please add some direction for us. Because, you know, we feel like we get whiplash daily on the tariff narrative. Friday, we thought we were going to get Canadian and Mexican tariffs. We didn't get those yesterday. Today we get Chinese tariffs. So the world is evolving and our thinking evolves. How do you see through all of this fog of tariffs?
Yeah, good morning, Anna, and good morning, Guy. On the tariff question, I think it really emboldens our view of U.S. outperformance. We've talked about how the U.S. stock market continued to outperform the rest. So it's U.S. versus the rest, not just Europe at this point. And the tariff question and the tariff debate sort of back and forth reinforce our conviction there.
That's interesting because, I mean, there were a lot of casualties yesterday in a market sense from the Trump tariff narrative. One of those was US stocks for a while, and there was a lot of expectation that, look, this is going to actually weigh on the US economy, push inflation higher and weigh on GDP. But you don't think that makes a difference to that US exceptionalism story? So
for a while, we've seen US outperformance on the upside. I think yesterday you've seen more painful points in Europe, for example, the Europe car makers, the Europe more cyclical sectors. I think in the US you have an abundance of long-term growth stories that can be somewhat insulated from these tariff noise. That said, yesterday you also see technology stocks in the US selling off. But to me, it's really a short-term phenomenon. It's a function of liquidity and positioning rather than any impairments to the fundamentals for these stocks.
What is the Trump trade? We thought the Trump trade was a kind of risk-on narrative. Is the Trump trade still a risk-on narrative?
Yes, the Trump trade, is it still risk-on? I think that's the events of the last 2 weeks have called that into question, right? I think at inauguration, people have maybe grown a bit complacent about tariff and policy risk. I think the market is more awake to that now. We're still to find out, but I think long dollar is quite consensus at this point.
Still, so the long dollar trade's still on?
Continues to work. We've added to gold in May, so with geopolitics going on in tariffs and also elsewhere in the world, gold continues to work. So we're holding on to that neutral position in equities and then adding to gold.
Is the dollar going to be a headwind at some point for US stocks?
To strengthen the dollar, I guess there is that potential for there to be currency effects for non-earners in the international markets. But I think overall, if you zoom out over the earnings potential for this year, the market is still expecting low to mid-teens growth for earnings for the S&P 500, for example. So I think that continues to underpin a strong market this year, as we expect for US equities.
And do you see anything that changes the competitiveness conversation around Europe? And I mean, through the Biden administration, we talked lots about the IRA and the way that was encouraging investments in the United States and not necessarily seeing so much of that in Europe under a new regime. Does that get worse? That split get worse? Or do we see something different?
Competitiveness, we've heard the good chatter outside of out of Europe. We've all seen the Draghi report. I guess there is an acknowledgement that there's something needs to be done. But that said, we think the story, but there's still some way to go until we see meaningful action and for that to play through to the Europe versus US competitiveness landscape.
And does that play into your thinking about Europe and where you invest in Europe?
In terms of Europe opportunities, it's quite idiosyncratic so far. It doesn't feel like it, but actually year to date, Europe has done quite well versus the US. I think it all comes down to pockets of strength. For example, in the luxury sector, you're seeing a bit of a bounce because there's that strength in the US consumer lifting the rest of their exposure. In semiconductor equipment, there is still that bounce in orders, bounce in that long-term opportunity for capex. So there are pockets of opportunities in Europe for quality companies, but we're not yet in a position to call a cyclical recovery for the broader Europe market yet.
Is this an environment in which you take less risk, though, in your portfolio? If you're a PM sitting there at the moment, is the instinct to take less risk, do you think? And do you think there is a broader effect that comes from that?
Risk positionings in this market, it's challenging. I mean, it's uncertain.
Yeah.
The news flow can change from hour to hour, from morning to afternoon. At the moment, we are neutral equities, so that means we've taken some chips off the table, taken some risks off in late December, in early January. We're holding on to our money market funds position. We have more cash equivalents than usual in client portfolios, exactly in preparation for
why? Sorry, yeah, you were about to say, why would you do that? What is the objective there?
This has been our position going into this year. We're hoping to take advantage of volatilities, just like what's been playing out. That's it. We're taking time to assess whether there's any damage to the long-term fundamentals for corporate earnings.
So dips, you still buy dips? So if you see a dip, you buy it?
We're still quite positive on risk assets
in
terms of our earnings growth potential for this year. We still think the S&P could deliver high single-digit 10% this year. That said, we are monitoring whether the news still really changes that fundamental view for earnings this year.
Yeah, are there any other dips you buy other than sort of US stocks? Are there other things, other themes you're looking to add to? And if things are repriced, you jump in?
What's interesting under the hood in the US market is technology, right? Because you've seen software names really lagging in the AI trade. That said, this year we're seeing a massive catch-up in software versus hardware.
Yes, because NVIDIA dominated, and now there are questions about NVIDIA, and so software catches up.
Exactly, so software outpacing hardware. And if you take a step back, we've been questioning how are we ever going to monetize all the investment in AI, and the DeepSeek new and all the news around lower cost to serve, I think could end up to be a positive news for the long term for AI adoption, for that monetization, most likely through software.
Palantir last night painting a very positive picture about what it sees going forwards. And great to see you. Thank you very much indeed. Ando, portfolio manager at Julius Baer, joining us on the outlook for these markets. This is what the Core 6 looks like here in Europe. Clearly, we have a banking story that is dominant in some ways with BNP Paribas and UBS out with numbers not reflected necessarily here. Novo soft, Ferrari soft, Schneider soft, Nestle soft. The tech story in some ways comes back. Hardware, ASML comes back. Luxury, absolutely flat right now. But the action is elsewhere in the chip space, you could argue, than ASML. Infineon front and centre. A big move, Joe Easton.
That is a big move, as you say, Guy. We've got Infineon up almost 12% now, coming back down to around 11%, but a big move in this stock. Now, remember, the company bucking the trend in terms of the semiconductor firms that have actually reported weak guidance. That was a note from Citi that I read. And also, as Anna pointed out earlier, there is, of course, the FX effect with the weaker euro benefiting the exporter there in Germany. So that is partly due to the euro effect on Infineon. But a big move out in terms of that. Then in the banking space, UBS edging up very high, $3 billion worth of buyback for the company. Of course, we did have BNP as well, announcing $1 billion of buyback themselves. But it does look like UBS is continuing the gains. They're only a small move higher now, up 0.2% for that one. In terms of Diageo, it's not getting any better for the maker of my favourite beer, well, pretty much everyone's favourite beer at the moment, Guinness. Diageo coming down. They've withdrawn their sales guidance once again. Not looking great for the company. That stock lost around a third of its value, as we showed earlier, on a 2-year basis. Then in terms of the healthcare space, Bavarian Nordic. Now, this is the company that made the Mpox vaccine and did quite well in terms of their sales, and a big rally for that stock recently. But coming down, it does look like there is some weakness on their sales, according to analysts. So that's a weak one today. And another weak one, which we don't see weak very often in terms of intraday moves, is Vodafone. Now, Vodafone reporting softness in Germany, according to analysts. The organic sales missed expectations. They've reported organic sales down around 6% in Germany for the quarter. It was expected to be down 5%. So that's the reason the UK company is declining today. I believe that was the worst on the FTSE 100. Vodafone down 4.8% in London this morning.
Thanks, Joe. Joe Easton from our equities team. A quick word about some of the other coverage that we're providing here at Bloomberg. Bloomberg's Jemana Besetcha is holding a fireside chat with the Turkish finance minister right now. That's from a Bloomberg Future of Finance event. It's taking place in Istanbul. If you want to keep across the Turkish story, you can watch that conversation in full on the terminal using the function Live Go. And we've heard from Simsek talking about the focus being on inflation, and in the short term, that might mean some downside risk to Turkish growth.
Let's turn our attention back to what is happening with the banks. UBS trading higher after a positive 2024 and $3 billion worth of new buybacks. We're going to take you to Zurich next. Francine Lacroix standing by after her conversation with Sergio Ermotti to update us. That's next. This is Bloomberg.
We are well prepared in terms of what it means for us in terms of risk management or capital management. That's the reason why we run a balance sheet for all seasons. But eventually, a bank is potentially going to be affected by second-order effects. What does it mean to the economy, and in turn, what it means to our clients? And therefore, no matter if they are wealth management clients or they are corporate clients, there is a second-order effect on us. And what we need to do is to stay close to clients and help them to navigate this challenging environment.
Challenging environment. We're certainly seeing some volatility in the stock this morning. UBS gapped higher at the get-go and is now falling, and in reality, as you can see on the screen in front of you, is now down in negative territory. On the face of it, this looks like a beat and a boost to the share buyback. Francine, talking to Sergio Ermotti there, joining us now. Francine, generally, this looks like a good set of numbers. The surprise seems to be coming through maybe in the repatriation story, the return of capital story. Did he address that?
Well, I have to say the surprise is really that the share price started 3% higher, and now it's down by 1% without any real catalyst. So, when you look at the numbers, it seems like it's a solid set of results. Of course, there's still this overhang of the capital requirements. Now, I did try and press him and say, look, does he get any news out of Swiss authorities, out of FINMA, of what they plan to do with it? Remember, this started about a year ago, where the talk was, look, if they have to repatriate money to pay us for capital requirements, this would be extremely expensive. He just doesn't get drawn on it. He says, look, we'll see. There's, ongoing discussions. One thing I tried to try and understand from him is whether he thought regulators in Switzerland would soften because of what's expected to happen in the U.S., which is deregulation, clearly giving Wall Street advantage. And again, Sergio Ermotti really being very tight-lipped, saying, look, we'll have to see. For the moment, he doesn't know. But it doesn't really explain the share price movement that we've had over the last 10 minutes.
Yes, so something happening there. In terms of, Francine, good morning. In terms of the outlook for the rest of the year, within the sector, there's optimism about maybe what the US economy might look like. On the other hand, nervousness around tariff controls and where that takes us. What is he expecting in terms of market volatility?
Well, he is expecting market volatility, and he was very clear in saying, look, when you look at the last couple of weeks, there was a lot of surprises. We talked about AI and DeepSeek. He also said if you look at some of the markets, they're clearly, if not priced to perfection, they could be due for a correction on certain metrics. If you look at what this means for a big bank like UBS, if you're on the right side of a trade, it's not bad at all. If you're wealth management and there's a lot of volatility, and again, you can service your clients, it means that fees won't be slammed as much. So he doesn't necessarily see it as a bad thing, but it's another headwind to think about, especially if it impacts inflation, therefore interest rates, and that has an impact on their net interest income. But overall, look, today was okay. In terms of the outlook, he says there's nothing to really be worried about. Of course, they're still going through this integration process of Credit Suisse. They're about 6 months ahead of time, but he says watch out over the next couple of months as they migrate some of the clients, and so that's IT and quite a delicate phase, I would say, in the integration of Credit Suisse within UBS.
Where does the growth come from next? Does Trump and what he is delivering encourage Ermotti to think about maybe expanding more in the United States? Geographically, how is he thinking about it?
So I asked him straight, look, do you want to acquire anything in the U.S. given deregulation? Again, we've caught up with Sergio Ermotti many times over the last month or so, and he's always looking at Wall Street saying, well, this is where the growth is going to happen. This is where they get deregulated. But he says, look, at the moment, there's still, because of the integration of Credit Suisse, there's still a lot to be done at home. But he certainly didn't rule out growth and even, the possibility of getting bigger through acquisitions in the U.S. But this is clearly, he says, for another phase, not in the current phase or now. There's still quite a lot to do to absorb Credit Suisse.
Francine, thank you. Francine Lacroix, of course, on the road in Zurich, talking to Sergio Ermotti and bringing us that UBS story. Let's move to another corporate earnings story that certainly has had a big market reaction. Infineon shares substantially higher this morning, up by 10.4%. I spoke to the Infineon CFO, Sven Schneider, and asked him about the state of the sector.
We continue to expect this, we call it gradual or modest recovery, not a big upswing, but a modest recovery in the second half of 25. And why is that? To your question, there are strong growth buckets. One is AI, the other one is still the electrification of cars, for example, in China. And the third one is that the first 6 months are heavily impacted by the inventory correction of many of our customers, be it on the automotive or on the industrial side. And we expect that inventory correction to phase out in the next months. And that is the core assumption for our yearly forecast.
OK, so that's the forecast and what they're based on. Can I also ask you about tariff impact? We're talking now, Sven, just moments after hearing that tariffs have gone on to China from the United States, and then China has retaliated with its own tariffs. You do business in China. We're also thinking about the possibility of tariffs from the US into Europe. How concerned are you about the tariff impact on your business?
Yeah, so to be very clear here, a major escalation of the tariffs is not included in our guidance. Because we still are not giving up in advocating for free trade. We do not see that as positive for the industry. So an escalation of tariffs and counter tariffs would be negative. But I also can explain to you that if you look at Infineon, if you think about us in terms of the sales footprint, but also in terms of the manufacturing footprint, we are globally diversified. And of course, we are used in a semiconductor industry to work with these situations, but the speed and the intensity, when I woke up, I learned that Canada and Mexico seem to be pushed out by at least a month. That has increased, and of course we are watching that very closely in order to analyze the implications and then to draw the right conclusions.
You're diversified in lots of ways, Sven, but the business is still very reliant on the car sector, and that could be an industry that faces more tariffs. Are you making any base assumptions about tariffs at this point? You said that no major escalation in tariffs is included in your numbers, but have you made any adjustments on that front?
Yeah, so indeed, the automotive industry represents, give or take, half of our business, so that's very relevant. But here again, to my point, it is a global market, but it's also a regional footprint in terms of manufacturing and sales. So we have manufacturing in Europe, we have manufacturing in Asia, we have manufacturing in North America, and this will help us to mitigate certain effects. So smaller tariffs are included, but as I said, no major escalations. That would require further analysis.
OK, so smaller tariffs are included, but not any major escalation. Can I ask you about European competitiveness, Sven? Because you talked there about the different geographies that you operate in, so you're very well placed to talk about Europe's competitiveness. You've benefited most recently from a drop in the euro. That perhaps helps a little bit. But what other suggestions, as Europe thinks about how to make itself more competitive, what other suggestions would you have?
Yeah, indeed, the currency, as you said, is a tailwind, but I would not count on the currency because that can always go into different directions. I would say that what we are expecting the most, and there is a broad consensus on that topic, is that we have more political regulatory stability. On the one hand, and we are welcoming very much the very recent announcements from the EU, we need to look at some overarching regulation which has been announced in the past and bring it down and scale it down to levels which are adequate, for example, also for investors.
That was Sven Schneider, the CFO of Infineon, speaking to me earlier on. And really interesting, the stock is doing really well, Guy. They upgraded their guidance. But he said in that conversation, only half of that increase is to do with the underlying business. Half of that is an FX tailwind. And even he said, I wouldn't count on the FX. Now, a lot of people are talking about whether the euro goes to parity, and that would boost that business. They gave some quite sort of big numbers as to how much a weaker euro really does boost their
Does the opposite then work for US companies? You think about the kind of the tailwind of a weaker euro, maybe for Infineon. Think about what is happening over in the States and the maybe headwind that the dollar is creating there. Infineon is the only chip maker exposed to the auto sector that has raised guidance in this earnings season, according to Jeffrey. So it does stand out from the pack a little bit as well.
Yes.
Is that because of the FX? Is that because of something else? Is it just better at managing inventory than maybe its peer group?
He was talking about this sort of a positive view of the second half of the year, and that, to your point, does seem to be a bit of a standout performance. They had this same view in November, and going into these numbers, a lot of people were saying, did you get too positive too prematurely? And actually, can you still... But they're sticking to that November guidance, saying, yes, we do see something, a gradual upswing in the second half of 2025. And, of course, AI is a real positive, and it's something that is increasingly coming through in the numbers.
But they have... It's the exposure to the auto sector that's just a great unknown.
Yeah.
How do tariffs affect that? How will what is happening in Mexico affect that? The volatility around all of this, really difficult to navigate.
And if you see the Chinese trying to use more of their own domestically made chips, if they go up the up the scale in terms of producing their own chips, and then that becomes difficult for the European suppliers.
Diageo this morning has withdrawn guidance. Here is a company that again is exposed to that same sort of buffeting that we're getting from the Trump tariff story. It has withdrawn guidance. Infineon, interestingly enough, sticking with its and in some ways managing the inventory story maybe fairly well compared with its peers. Coming up, what would a prolonged trade war with China mean for the American economy? We are going to ask Aditya Bave, senior US economist at Bank of America Global Research, who is in London this week and joins us next. This is Bloomberg.
Welcome back. This is the opening trade. 30 minutes into today's session, and things taking a turn for the worse, it would seem, across European stocks. So we're now down by 0.5%. This is all happening pretty quickly, escalating pretty fast. We had seen a bit of a turnaround at the start of the trading day. That's not endured. Technology providing some upside. That's the Infineon trade. But to the downside, we see the auto sector, which, of course, is a big customer of Infineon. So we'll see how long that lasts for. But things deteriorating a little bit, Guy. It
does seem so. It was interesting to see how quickly UBS in particular turned around. We're certainly getting used to volatility. Yesterday was certainly a session that delivered plenty of it. The Canadian dollar, the Mexican peso rebounding against the US dollar as leaders from the two countries said they'd managed to strike deals with Donald Trump and that tariffs were therefore to be paused. President Trump laid out his reasons for the pause on the levies, particularly when it came to Mexican goods.
They've agreed to put in 10,000 soldiers permanently, like forever, 10,000 soldiers at their side of the border and stop fentanyl and illegal aliens from coming into our country. They have a big incentive to do. Other than that, we've agreed to talk and consider various other things. We haven't agreed on tariffs yet, and maybe we will, maybe we won't.
Aditya Bave, senior US economist at Bank of America Global Research, joining us around the table this morning. Nice to see you in London.
Good morning. Thank you for having me.
We have lots to talk about. So let's dig in first of all to the tariff story. It's not going to happen with Canada. It's not going to happen with Mexico. But the threat still exists. You'd highlighted the fact that you didn't think actually that the Mexican-Canadian tariffs would be long-lasting, even if they did come into force.
Yep.
But what effect does the uncertainty have in terms of how the economy evolves from here?
Right, so there's definitely a risk here that the uncertainty could weigh on business investment. Business investment was obviously a little bit soft in the fourth quarter as well. So that's something that we'll be keeping an eye on for sure. But When things are moving around so fast, I think it's really important to have a framework to anchor your views. And our framework has consistently been that Canada and Mexico will avoid sustained tariffs. As it turned out, we didn't get tariffs at all, at least for now. And the reason for that is two things. The first would be that Canada and Mexico are very incentivized to work with the U.S. to find solutions. And the second is that tariffs against Canada and Mexico would also be quite disruptive for U.S. manufacturing.
Can the same be applied to China?
Less so. Less so. With China, we think it's a very different story. It's really, you can think of the trade war within the context of kind of a broader geopolitical issue that's much harder to resolve. So the 10% tariffs against China are much more likely to remain in place, partly or quite substantially. And the other point I would make that I think is quite important is that 10% is calibrated. 25% is a big number that makes it less likely to be sustained, right? Whereas 10% is something that you could potentially sustain, and the removal of the de minimis exemption is also quite important.
Aditi, good morning. Let me ask you about what this does to the US economy in a bit more detail then, because I was reading some research by Bloomberg Economics, talked about the average US tariff. If we'd had all of these tariffs going on, they estimated that would go up from 3 to 10%, 10.7% or so. And now they say with the China tariffs going on, that goes from 3% to 4.2%. So it's an increase, but not a huge increase on the average tariff on things going into the United States. So what kind of impact is that going to have on the US economy?
Right, so I agree. When you take Canada and Mexico out of the picture, the numbers become much smaller. So we expect a small impact on the economy. I mean, you can start with the total tariff rate and you can say, okay, there's a bit of an offset from FX, there's potential exclusions, and the rest of it is essentially either absorbed in margins or absorbed by the US consumer, right? And we think of it as about 1/10 on the core PCE, 0.1%, and maybe up to 0.1% or even less than that on growth.
So this is that's not huge, I suppose. So I guess that goes towards your argument that this could therefore stay on for quite a long time,
exactly,
if it's serving a geopolitical purpose.
Exactly, exactly. The concern here that maybe makes it a little bit different from 2018, 2019 is that we're in a very different environment in terms of inflation. There's probably more willingness to pass costs on. And also this time, at least for now, the tariffs have also been applied to consumer goods. So think electronics. Think of all the stuff that we buy online, right? A lot of that was not subject to tariffs in the first Trump administration, and for now, at least, it is subject to tariffs.
I think Trump can deliver tax cuts if he doesn't do tariffs.
We do think that the Tax Cut and Jobs Act will be extended.
Right.
Beyond that, we expect some further cuts, right? So you could, for example, get full expensing of CapEx extended.
Was it ever realistic that tariffs were going to be able to... there was some sort of balance here between tariffs coming on and tax cuts being, therefore, more achievable? Is that a line that you, as an economist, that you look at the US economy, can actually draw?
The math is somewhat challenging on that.
That's a very polite way of putting it.
The way I would think about that is that there's other reasons that the deficit keeps increasing, right? Interest costs are going up. The population is aging, so you're spending more on entitlements as well. And with tariffs, the reason the math is difficult is that there are incentives to kind of reroute supply chains or rejigger supply chains in order to reduce the tariff burden. So I wouldn't think of tariffs as a reliable source of revenues in the long run.
What's the immigration policy effect that you're thinking about here, Aditi? Because I was looking at some analysis by one bank that talked about the number of jobs created last year through immigration, through new labour coming into the market via that route. What assumptions do we therefore make based on Trump's stated policies?
That's a great question. Our base case is that the flows of migrants across the southern border are going to slow further, but they've already slowed quite meaningfully over the last several months, right? So in that sense, the delta might not be huge. And then we'll just have to wait and see in terms of actual deportations, right? Whether the numbers turn out to be quite large or whether there's a focus somewhat narrowly on people with criminal records.
Yes, a lot of headlines generated, but maybe less economic impact in that case.
Potentially, although, you know, there's all these intersectional effects that you need to watch out for. For example, there's certain sectors that will be impacted a lot more than others. So think construction, think leisure. And then with construction, you think about, okay, well, there's going to be this demand for construction spending in LA, right? So is there going to be a labor shortage there? That's something we'll be watching for.
Should Powell just sit on his hands? You just laid out so much uncertainty. Should the Fed just sit, wait, watch, try and figure it out, understand what the implications are going to be?
That's been our view, and we've been out of consensus on this. So we, after the December jobs report, said the Fed is done cutting. And the reason for that was, one, they were cutting because they were worried about the labor market, but the labor market has now stabilized, and two, inflation stuck above target. And then all the risks to inflation are to the upside, right? So
if they're done cutting, is the next move a hike?
Potentially. I think there's some room to there's some leeway before they right. So 3% core PC, I would say, is when you start getting worried about a hike. But if that's just because of tariffs, then maybe you're able to look through it as long as long-term inflation expectations remain anchored.
But the Fed is done implies there are no more cuts. So logically, you would assume the next move is a hike.
There are no more cuts in the near term. Maybe there are.
In this
cycle,
near
term?
Yeah.
Well, our forecasts go out to 2026. Obviously, by mid-2026, you'll have a new Fed chair. And at that point, we might have to reassess things. But for now, for this year, we feel conviction that there won't be cuts, potentially next year as well.
That's a huge pause for the Fed. Is there any kind of historical precedent? That is a hugely elongated period for the Fed to be on hold.
So on average, when they stop cutting, they can be on hold for 6 to about 13, 18 months.
Right.
So it wouldn't be completely without
precedent.
precedent.
Complete outlier, but it's stretching the kind of boundaries of what we normally would see.
Yes.
It's going to be interesting to watch.
It is.
Aditya Bave, thank you very much indeed for updating us, senior US economist at the Bank of America Global Research. What have we got coming up?
Coming up, we'll focus back on the German economy. German industry was already dealing with economic growth challenges before the threat of Trump tariffs added to the list of headwinds for the business sector. We will cross to the port city of Hamburg and hear from the CEO of the Hamburg Chamber of Commerce next. This is Bloomberg. Welcome back to the opening trade. 42 minutes into a European session that seems to be losing momentum a little. US futures now down by 0.3%. Technology, the only sector that's moving higher, and that's the Infineon story, getting a positive response there. UBS, the worst performer in the financial services sector, and that's because it seems a lot of the positives were already priced in, Guy, but concerns around capital requirement rules weighing on that particular stock.
Yeah, the only lines I've seen that I can kind of logically kind of work my way through are it had a great run into earnings. There's a bit of profit taking. People are taking a few chips off the table after what has been a decent run. It's going to be interesting to see how the US deals with the China story. It does seem maybe as if that feels, as we were just hearing from Aditya, maybe is a more sustainable impact. And while it may not be as dramatic as the 25% tariffs, it's only 10%. If it is more sustainable and more concrete, it therefore does have an effect, albeit maybe a little bit smaller. So maybe that's what we're beginning to think about as we start to approach maybe what is happening with the US session a little bit later on. The trade war story is pretty much everywhere you look at the moment. The European Union certainly bracing for a possible trade war with Washington. This after Donald Trump's recent threats to hit the bloc with tariffs. EU leaders, including Germany's Olaf Scholz, have vowed to retaliate. Bloomberg's Oliver Crook takes a look at the impact tariffs could have on Europe's economy, in particular, what they would do to Germany with an election just a few weeks away.
To me, the most beautiful word in the dictionary is tariff. And it's my favorite word.
As the United States and the EU square up to what could be the next front in Trump's trade war, at risk is the biggest and most integrated bilateral trade and investment relationship in the world. There's no free trade agreement between them, but operating under WTO rules, they enjoy some of the lowest tariff rates anywhere, at about 3%. The EU and the US trade about 850 billion euros worth of goods, with Europe running a surplus of about 155 billion. Meanwhile, trade in services was worth almost 700 billion, where the US runs a surplus of about 100. Combined, the exchange of goods and services was bigger than almost every single European economy on its own, at least for now.
And remember, again, the word tariff. We're going to protect our people and our businesses, and we're going to protect our country with tariffs.
According to Goldman Sachs, a 10% minimum tariff would reduce EU exports by about 150 billion euros every year, shaving off about 1% of European GDP. And Germany would pay the highest price. Germany's effort to de-risk from China has meant the trade relationship with the United States is more important than ever, and new tariffs by Donald Trump could cost Germany 15% of its biggest export market.
So the impact of tariffs, Germany and the rest of Europe waits to hear what the US has in store. Let's go to Bloomberg's Oliver Crook, who you heard reporting there. He joins us now from Hamburg. Oliver, what takes you there with the election under 3 weeks away? Of course, trade very much on our minds.
Yeah, that's right. I mean, Anna, we talk about trade and often very much sort of into the abstract, but when we think about the German economy and what has been the sort of really great wealth driver for the German economy for the last several decades, it's really been a sort of system of globalization and trade. It has been a system that has brought a huge amount of wealth to the people of Germany. And when we think about it in the abstract. We think about billions of dollars. We think about tariffs of 20%, this, that, and the other. But behind all of that, like you can see behind me, is you have a very complex international system of trade where these goods actually move. And we speak to the people who have been building these from the ground up for many, many decades. And we have the opportunity to speak to some of them right here. The CEO of the Hamburg Chambers of Commerce, he's Malte Heine. He is looking after the sort of interests of the business groups around here. This is the oldest Chamber of Commerce in Germany, established in 1665. You look after the interests of 180,000 businesses around Hamburg. I'd like to begin, before we get into the sort of trade war and all of these sort of narratives, for you to sort of situate us in this harbor here and its importance to Germany.
Right. This is we are here directly in the heart of Hamburg. The Hamburg port is the platform for the whole business community. It stands for 9 million containers turnover, and it's 2/3 of German overseas trade is running via Hamburg port, making it also the largest industrial compound area in Europe, and lots of heavy industries here. So our economic powerhouse.
So it's really fundamental. So when you have 48 hours like we just had out of the United States, where you had 25% tariffs here and there, and then they're gone for 30 days, and you have 10% with China, what does that make you feel? And what does that make these sort of companies that you represent feel? How sensitive, how vulnerable?
We have lots of concerns about that. It doesn't really surprise us because Trump is doing what he told on his election campaign. But for us, it's the foreign trade hub of Germany. It's a terrible situation, and the outlook is quite pessimistic that we are facing, because that will even put more pressure on German economy now.
And if you were to get 10% tariffs on the EU, as this is sort of what is being discussed, I know that maybe you'll be able to negotiate it away. What kind of impact do you think that would have on this harbor, on the sort of German economy and surrounding area?
So it's hard to actually calculate what is the impact. It's going to be a bad impact, and also we put other tariffs from the European Union. This is all we need, more free trade as a destination. But to see our economy in Germany is lacking of competitiveness in international regards. So we have too much bureaucracy, and energy prices are too high, and all things like this. Tariffs making exporting goods more expensive. So we need to reduce anything and to train our competitiveness.
And in terms of that competitiveness, I mean, you're also building trade relationships with China, with India. What do they want to see here, and what makes Hamburg a sort of, and what makes it Port an attractive place to come? What are the features that you're trying to sort of advertise to them to attract them here?
German economy is always dependent on international trade, and this is the gateway to the world that we have now, and we are seeking for new markets. As the port, we are very, very dependent on China. 1/3 of our container turnover has something to do with China, but we are now developing new markets, like in India, like in Vietnam, Southeast Asia, but also Latin America. The EU-Mercosur agreement is very important to our economy.
Have you had contact with a lot of sort of companies? Have you had sort of delegations go to South America and discuss with
lots of interest? Also in building energy partnerships, like getting the green hydrogen from Latin America, from Chile, Argentina to Germany. That we are
How big do you anticipate that's going to be? Because I keep hearing people talk about green hydrogen. I still don't see kind of the economic sort of viability behind this technology yet. Is this something that's going to be a real driver?
Yeah, definitely. It's going to be a real driver, because we are already building the infrastructure in our port, the import infrastructure, and we have the industry companies from manufacturing sites. They are also practicing hydrogen in as energy supply in their processes.
And of course, one of the sort of big issues that we're going to be paying very close attention to, and you are, of course, is a few weeks away. You know, you have this election here in Germany.
Right.
What does the Port of Hamburg need? What do the companies you represent need from the next German government?
Yeah, no, we need something like economy first, business first, and we need to do anything from the political perspective to increase our competitiveness. You know, it's like anyone is talking about the sick man of Europe as a German economy. I have another opinion because we are the lazy man of Europe sitting on the couch, and we need to stand up and do our exercises. So reducing economy, investing in infrastructure, and working more and harder to increase competitiveness.
But when you see the sort of political landscape and what's going on in Germany right now, at number 2, and some polls say there's only a 6-point difference between the CDU and the AfD.
Right.
The AfD is a party that wants to withdraw Germany from the European Union.
Yes.
It wants to. It's not a very global-facing business. It's really the antithesis of what we have here. How much does that concern you?
Yeah, definitely a lot, because you know, we are so dependent on international trade. On the European Union is so important to the business community, so we need to stay in here. And also we need to security issues. Pulling back from the NATO is also very bad perspective for the business community. We need to be an open society. We have a lack of skilled working force, so we need more migration into the labor market again from skilled people.
And when we think again of the long history of the chambers of commerce, hundreds and hundreds of years. When you see what's happening now, not just with the United States, but more broadly, it seems like there's a sort of ebb. You had globalization reach its high level, now coming down, feeling this deglobalization. Do you think that trend will stop, or how do you see the future of that?
I think merchants will always seek for new markets, and we have a long tradition in international trade, as you mentioned. And I think I have so many companies that are also looking for where to get new materials, where to export their goods. So I think there will always be globalization, but it's going to be hard. Any tariffs, any trade wars that we are facing is not a good development. So we need more free trade agreements.
And just before we go, I'd like to hear something optimistic about the German economy. What do you have to be optimistic about for the coming years?
Also optimistic because, you know, we have it in our own hands. It's more regulation. Politicians can invest more in infrastructure. We need to accelerate our infrastructure planning rights, which is also possible. So it's a mechanism that we need to implement to increase our competitiveness, and that's possible.
Well, Malte Heine, thank you so much. That was the CEO of the Chambers of Commerce here in Hamburg, who says that Germany really needs to be less lazy, needs to get off the couch and really get its act together and moving into this election.
Yeah, not maybe the sick man of Europe, just the slightly under-exercised man of Europe. Maybe that is the way of putting it. Lazy. I wouldn't quite go that far or be brave enough to do so. But nevertheless, it's interesting to see that actually it's about economic fitness now. You do wonder if you could ultimately see Europe benefiting from Trump by basically just being given a kickstart. You can catch the interviews from Ollie all throughout the morning. Ollie Crook live from the Port of Hamburg. Special coverage also on how the new German Chancellor may navigate the trade and tariff challenge. All of that starting 9:30 a.m. UK time.
Now, the pound is emerging as an unlikely haven, to some degree, for now. The UK avoids Donald Trump's tariffs, so can it continue? Prime Minister Keir Starmer spoke at NATO headquarters in Brussels, where he's been seeking to reset relations with Europe.
Days. And I think what's really important is open and strong trading relations. And that's been the basis of my discussions with President Trump. And I know that intense US-EU discussions are planned.
Our UK correspondent Lizzie Burden joins us now from Brussels. I mean, the extent to which the pound is acting as a haven, very limited, Lizzie. But can Starmer court both the US and Europe at the same time? That seems to be what has fallen to him as quite a difficult challenge recently.
Indeed, and it was a really interesting moment for Keir Starmer to be at NATO HQ in Brussels, given, first of all, the question of whether Trump's tariff threats on Canada really threaten the NATO alliance itself, and secondly, as you say, whether Starmer is going to have to pick between the US and the EU if Trump eventually forces him to. Starmer says that he's talking to both sides. Mark Rutte, the NATO Secretary General, says there are always issues between allies. But Anna, quite frankly, these are more than issues, and you have to wonder how long Trump will let Starmer sit on the fence here. Trump has suggested that the UK can escape his tariffs because US-UK trade may be out of line, but Trump says that one can be worked out. You have to see that the more Starmer aligns with Europe, the less room he has to accommodate Trump's demands on trade. And what's for sure is the UK cannot afford to have a trade war with the US, and no one knows that more than Keir Starmer. The risk is that Starmer offends both sides, but then there's also the point on defence. Starmer echoed Rutte's message of, to prevent war, you have to spend more. That is falling on many deaf ears here because he hasn't set a deadline for when he'll spend 2.5% of GDP on defence. Some of the French officials are calling him the demandeur.
OK. We'll watch to see whether any demands from the United States around a trading relationship, whether they threaten what is in place to a limited degree with Europe. Lizzie, thank you very much. Bloomberg's Lizzie Burden in Brussels for us. Guy, taking a step back then, looking at the broader market story, it has weakened, hasn't it? The IBEX, with the Spanish banks recovering, actually in positive territory, but all other European markets are down.
So in terms of where the damage is being done this morning, Novo is soft. It's down by 1.5%. So Novo Nordisk is certainly taking a hit this morning. UBS is the next biggest hit in terms of the points. An hour ago, when we started trading, this stock was it gapped higher. It's rolled over really aggressively. It's gone from the top to the bottom. I know they're in slightly different sectors, but BNP Paribas is the second biggest points gainer. So BNP Paribas is still doing well, up by 2.5. UBS is now down by 3.6.
We've had some interesting response to the trade tariffs through the lens of the corporates as well, with the likes of Diageo removing its medium-term guidance, and that stock down 4% as a result of just, huge amounts of uncertainty about what that business looks like if tariffs come back into the conversation in North America. That is it for the opening trade. Markets are a little negative this morning. The Pulse is up next. This is Buyback.